Hello, fellow female founder. Quite the mouthful. I'm Nicole. I'm really super chuffed, super chuffed to be hosting this masterclass tonight. I'm the founder or co founder rather, of Sllick, where we specialise in all things apps, accounts, and automation. So I'm a chartered accountant, full time geek, and I love helping business owners save time and take care of the finances from a day to day perspective. So, straight on to the masterclass. Tonight, or whenever you're watching this, I am going to be covering some of the basics from everything from a limited company to VAT to bookkeeping, the day to day stuff that you need to do to keep on top of the finances and how to interpret what the numbers mean. Most of this content is going to be just applicable in the UK. Obviously, tax has changed no matter what country you're in, but bookkeeping and things like that will apply to anybody across the world. So sit tight, I'll try and make this as fun as I can, and hopefully you can get some real great value from what I'm going to talk about. I'm going to talk about limited companies and what they are. So a limited company is a separate thing from you as a person. So it's taxed separately, it's looked at legally separately from you as a person. I almost think of it as an extension of you. So although I maybe own a limited company and I have the shares in it and I'm working in it day to day, it isn't me personally. Maybe think of it as putting on a separate hat. Today I'm limited company Nicole, tomorrow I'm just Nicole. So from a tax perspective, it's taxed differently. From a legal perspective, it's different. From banks, things like that, they look at it differently. Limited companies are all registered with a body called Companies House. Now, I imagine this comes from back in the day where there was actually a building where you had to go and register your company, but now it's all online. You can find out a lot about other companies from Companies House. A lot of information is quite public, so you do have to be careful about what you want to have on your company or what information you want to hold. But yeah, it's quite useful for finding out things about other companies. So, I will move my facey. So, some of the terminology around limited companies. Within a limited company, you will have directors or just one director. These are basically the people who are either in charge or are the person you would get in touch with if you had something to ask about the company or to get in touch with. They don't necessarily actually have ownership of the company. They don't necessarily have a financial interest in the company, but they are ultimately kind of responsible for the company. They're responsible for things like filing accounts, making sure tax returns are submitted, and any debt repayments and things like that. They're ultimately the person that needs to be in control of that. Then we have shareholders. These are people that have some sort of financial interest in the business and own a slice of the pie. Generally, they'll have paid some sort of funds to get this slice of the pie, and generally they're hoping to get some sort of return, whether it's a regular dividend because the company's making profit, or they're hoping that they can sell their shares in the future when the price of those shares increases and maybe the company floats on the public market, or it's sold off or something like that. Then we've got registered offices. So each company has to have a registered office. This is basically an address associated with the company so that they can't just be this ghost-like legal entity. Most people try to use an actual office of some sort. So if you've got offices or you've got local offices that you could perhaps ask, or your accountant maybe will let you use their address as the registered office, I would always recommend that. If you don't, what you can do is either look at paying for a virtual office, which basically there's ones in Edinburgh for about 20 quid a month where you can use their address. Any post will get sent to them and generally they'll forward it on for you. And it means that your personal address or your home address is private. If you didn't want to pay the 20 quid or whatever the cost may be, you could use your personal home address, but just be aware that that is public information. And if anything went wrong with the company, people could come chapping at your door, which would prefer that wasn't the case. Dividends. So this is how a company repays its shareholders effectively and how it gives them a return on their money. This is just a way of getting money from the profits, and I'm going to go into that in the next slide. Corporation tax is what companies pay. So you and I pay PAYE, we pay personal tax on any personal salaries or self-employed earnings or dividends that we receive personally. But with companies, they pay a different tax called corporation tax. Just now it's at 19%, but it's a way to go up to 25%. It is on a sliding scale. This is kind of in response to COVID. So we'll see what happens there, but most smaller businesses will only be paying 19%, which is generally lower than what we pay personally. Then we have annual accounts and abridged accounts. So by having a company, you do have some responsibilities for what you have to file and what you have to do on an annual basis. So once a year, you have to submit what's called a confirmation statement to Companies House. Confirmation statement basically says, yep, we still exist. Yep, these are the correct addresses for us. Yep, these are the right directors. Yep, these are the right shareholders. An annual update, basically. But you have to file that every year or you can be fined, which is obviously not much fun. You also have to submit annual accounts, abridged accounts, and corporation tax return to HMRC. You will need an accountant for this. The annual accounts are generally what your accountant will produce and will have more information about what has happened financially in that year. It will generally include things, key information about the company, what it does, what is the activity, who are the directors, who has an interest in the company, and then things like your profit and loss to show you how much money you made, what your tax liabilities will then be, and also your balance sheet, along with some notes explaining the balance sheet to see what the company value really is. So what assets have you got, what value have you got, what cash have you got, things like that. Although your accountant will prepare these big sets of accounts, what they file to Companies House is called, or generally is, abridged accounts. You do get other formats. Now these are a much smaller set of accounts with less detail, so less information is then being shared publicly. On Companies House though, people can still view these. You can get quite good information from them, but things like how much dividends you've paid to your shareholders, things like how much of a wage you took, that's a bit more private. You will see at the right hand side, I have a screenshot here of Companies House. Very simple website. But you can search for any limited company in the UK. So I've opted for searching for Tesco, for example, and I can see that the top search result is Tesco PLC. So I can click on that, find more information about who the directors are, have a look at their last sets of accounts that they've submitted, see if there's any security from the banks over their assets, things like that, loads of financial information. But if you're looking at possibly competitors or companies that you may be interested in merging with perhaps, you can also find out who to contact, because then you're going to see, well, who are the actual people that are interested in this company, who has control of this company. Great resource to have a nosy at. Okay, so we're going to talk about dividends just quickly. Dividends are a way of paying shareholders for their investment. At the end of the day, your shareholders and your investors want some sort of return, whether that's an ongoing dividend that could be paid once a year, say, or a return when the company sells or the business sells. It is paid, or dividends are paid depending on how many shares you've got. So if you've got loads of shares, you'll get more of a dividend, less, you'll get less. It's all just a percentage ratio. Dividends can only be paid to shareholders, 1, when the business has enough retained earnings, and 2, when it physically can afford to do so, so when it has enough cash in the bank. The retained earnings, it's basically accumulated profit over the years. So if you've made 20 grand of profit one year and 20 grand the next, you'll have 40 grand of retained earnings that could be paid out as dividends. You don't have to, they can just sit and accumulate, but that's basically how you pay out a dividend, by making profit. Dividends are taxed on the person that receives them, rather than the company. The company doesn't need to pay any tax on them. It is taxed differently than what our standard income is taxed. So for example, just now in the UK, as at the middle of January 2022, because this will no doubt change, you can earn £2,000 of dividend tax free. Then the next tax band is only 7.5%, and then the higher rate is 32.5%, and there's a sliding scale up from there. So it's much cheaper on dividends than it is on general salaries or earnings, which are generally at 20% without the 7.5% gap. But up to a point, it then becomes very expensive. So depends what your financial situation is, but that would be on the shareholder's responsibility to declare that in their tax return. The reason we started Sllick was to help businesses with how they operate the business day to day, not just why or what. So a big part of that was seeing where the time drains were and finding apps that helped them save time but get better information quicker. So as an accountant, I'm obviously interested in the financial side of a business. And I want to run through a couple of apps that we recommend almost daily to our clients. First one being Xero. So Xero is a bookkeeping product. It's web-based, mobile app-based. You guys all know way more about that than me. But you can do digital invoicing, send out invoices, send out reminders automatically, things like that. Your bank can feed in directly so you can see transactions really quickly and make sure you're recording all your expenses and your income. Easy to keep on top of your bookkeeping. You can also do things like VAT returns and your payroll through Xero. I'm going to touch on VAT next, but having a system in place to capture VAT is such a big thing. It's so much quicker and it takes off the burden of doing VAT. HMRC actually is pushing for digital VAT returns, so it's more important now than ever to get a proper digital-based bookkeeping system in place. With Xero, because it's based in real time, you can run reports really quickly and see how things are from a financial perspective. Loads of automation features. It's really easy to set up. It's built for non-accountants, so just the average Joe, so you don't need to be a qualified accountant or anything like that to understand how to use it. It's great because it can be, your advisor can have access, so we can give advice on the fly rather than having to wait for you to hand in books. And it's connected with thousands of other apps, which makes it so easy to flow data from one app to another. It's a subscription-based model, about £25 a month, but highly worth it. Next app I recommend is HubDoc. HubDoc was bought by Xero a couple of years ago. You may have heard of Receipt Bank. It's a similar sort of product, but it's free. It's included within the Xero license. It allows you to capture your receipts, so your costs. You can do sales as well if you were doing them on paper, but I wouldn't recommend that. I'd recommend digital invoices if you're invoicing. So you can take a picture of your cost on your phone through the mobile app, or upload a PDF or whatever it is you've got on the web app, or forward on an email with the invoice attached. It then reads the invoice, picks out key things like the date, the supplier, values, invoice numbers, VAT amounts, all that sort of stuff. So it really minimises the data entry that you need to do on a day-to-day basis, making bookkeeping really simple. It then pushes that information through to Xero, and then your bookkeeping's done. The good thing with this is there's automation within that as well, and it keeps a digital copy of your receipt with the expense. So for example, if you just bought a laptop, you've uploaded your invoice into HubDoc, which is then sitting in Xero, and you find that in 6 months' time it gives up the ghost even, or the goose. You could jump onto Xero, quickly find your invoice through the search functionality and get that repaired ASAP. I was chatting about VAT earlier. Again, HubDoc picks out all your VAT, so it makes actually doing your VAT return super simple. And it also starts to learn how you track your expenses and predicts how you want to post them going forward. So really helpful app, and something that we really promote our clients do. Tide is an online bank. Now, you might find, depending on how complex your setup is, that you might not be able to get a bank account with Tide, but generally if you're the only shareholder or you're just starting out, it's a great bank to get an account off the back. 100% online, so if you're dealing with cash, it's probably not ideal for you, but it's a really quick, easy application process, all online. They're currently offering a free account for businesses. You also get the app on your phone, and it links directly with Xero, so it saves you entering bank transactions, and it really helps speed up making sure your bookkeeping is bang up to date. It also helps you capture all your costs, because if it's all coming into zero, it means that you're reminded that you need to find an invoice for each transaction. And then the final app that I would recommend is Float. Float is a cash flow prediction app. It links again with Xero, so it looks at all your financial information in there and predicts what your cash flow is going to look like in the months to come. This is great for finding out if there's going to be any low points, if you actually need to get funded a bit earlier, and also sort of predicting if things are going to go the way you were expecting them to go. It looks at things like payroll, if you've got any staff members, and also things like VAT and liabilities like that are coming up in the future that are often missed or forgotten about. Again, monthly subscription, links directly to Xero, and it eliminates the need for Excel, which, as much as I love Excel, and I am a huge Excel geek, and I love a VBA, we just don't have time for that. So, anything to save a bit of time. It's real-time cash flow prediction. VAT. Okay, so when I wrote this title, I was thinking, what's love got to do? And then changed it into, what's VAT but a second-hand taxation? So, who knows where my brain went, but I clearly thought it was hilarious. So, VAT, value added tax. Something that we've been paying for years that we've got no clue as a consumer, but as soon as you're in business, you suddenly realise what a headache VAT can be. But it doesn't have to be too complicated. If you've got systems in place like Xero, it's practically taking care of itself. You probably will need to do a wee bit of learning, but generally it's much easier than it used to be historically. So, VAT is something you have to register for with HMRC if your turnover goes over £85,000. Now, there are other tidbits and little wee buts, but generally that is the rule. If it's over £85,000 your turnover in a 12-month period, you have to register for VAT. That then means that your sales or your subscriptions, whatever your income is, needs to then have 20% of VAT added to them. It's usually 20%. It depends what you're selling. If it's medical stuff, then it's a different rate, things like that. Generally speaking, 20%. Whatever you then charge your customers, you have to pay that over to HMRC. So that's a cost for you. Although all that's happening is you're collecting it on behalf of HMRC. Then what you can do is reclaim any VAT that you've paid on your expenses, and whatever the difference is what you get back or you pay to HMRC. The only qualm or the thing that you might find, on the basis that a lot of people on the Female Founder Squad are in tech, is if you're selling to people and you're based in the UK and you're selling to people out with the UK, you need to be careful with the VAT. It's really complicated as soon as you leave the UK, so I would definitely recommend you get an advisor or a VAT specialist to have a look through and set you straight from the outset. The VAT rules changed dramatically last January with Brexit, so it's worth getting a specialist to do an overview and just make sure you're on the right track. Anyway, so when you become VAT registered, you have to submit a VAT return either monthly, quarterly, or annually. Generally, most people opt for quarterly. You submit this to HMRC. If you're using it, it's quite straightforward through Xero. And then you have to pay the VAT over. You get a month and 7 days to pay it over. But you can set up a direct debit so that HMRC just collect it as soon as or not as soon, but after you've submitted your VAT return, they then collect it. Again, I'm going to harp on about Xero for probably the rest of this masterclass, but using digital bookkeeping software makes this process so much easier. I can't stress that enough. So definitely, if you think your turnover is going to be over 85k, do not avoid getting a digital bookkeeping software. So, if I'll pop on to my next slide. When it comes to VAT, I'll move my face. There are two different types of VAT. I just spoke about them briefly. Output VAT. Easiest way I remember what output VAT is, that I'm giving my services out. Sales, I'm making money from the stuff I'm giving out. So that's output VAT. Output VAT. Output VAT, you pay out to HMRC. Input VAT, I'm buying things and taking them in. I'm taking my services in. I'm paying for my accounting and I'm getting my accounts in. and I get that money in from HMRC. Just a quick tip, something that stuck with me for years. This is an example VAT return. This is from Xero's original VAT module. There's these boxes down the side. This is basically Xero collating all of your information and saying, right, this is all the VAT you've had on your sales. This is all the VAT you had on your expenses. This is the VAT you'll be paying over to HMRC. And HMRC also like to see how much sales you had and how much expenses you had. Key thing on this VAT return here is box 5, VAT to pay HMRC. Box 5 is basically box 1, which is your output, your sales, VAT on your sales. Take away whatever VAT you've incurred, so your input, so your costs, and the difference between those two figures is what you will pay to HMRC. Thankfully, now, Xero does this for you. You don't have to think about filling this in or anything, and it's linked directly with HMRC, making it super easy and quick to submit. But this is a VAT return. So, it's all very well doing your bookkeeping and getting accounts prepared by your accountant, but what do they mean? So generally the two key parts of the accounts are the profit and loss and then the balance sheet. Two separate reports, but they're both interlinked. I'm not going to go into the dynamics of double entry bookkeeping. If you've got a spare 10 minutes, quickly Google that and you will learn a little bit about the crux of accounting. So the profit and loss. Basically this report tells you the trade, how much money you made, how much sales you made, how much or how many costs you had, what the total of those costs were, and ultimately tax, corporation tax in a limited company, is calculated based on what that figure ends up being, so what your profit is. There's other things that go into that, like how many assets you purchased in the year, but we won't complicate things just now. The other report we've got is the balance sheet. So this balance sheet basically says, well, how were you able to carry out the trade? What instruments did you have to allow you to trade? When I say instruments, I mean things like assets. Did you have an app cost? Did you build an app? Did you have some machinery that helped you do that? Did you have a really high-tech laptop that you purchased? Did you have a loan? Were you able to get funds from the bank, for example? Did you have cash in the bank? How were you able to carry out that trade in a financial term? So I'm going to show you an example of a profit and loss report and a balance sheet. So this is Xero, and I'm running a profit and loss report just now. What this does is it shows me my turnover, so my sales, what that total was, any costs directly related to those sales. So if you were selling a product, for example, the cost of buying that product, the cost of packaging that product, the cost of shipping that product. Then we've got admin costs, or more commonly known as overheads. Now, these are general costs that the business has incurred that don't directly relate to the trade. So I couldn't say if I was selling hair extensions, for example, me paying for advertising doesn't directly relate to those hair extensions, but they do relate to me trying to sell those hair extensions. So they're just an overhead. They can't be directly linked to the hair extensions. So things like marketing, your accountancy fees, bank fees, if you have premises, the rent cost, anything like that. So they all populate here. They all get added up. And then we basically say, so how much money did you make from your sales? And then we take away the costs. And that really is the crux of how to figure out what your profit is. This isn't necessarily how much money is in the bank. This is just your profit figure. Sales take away expenses. The key thing with this profit figure is that's the starting point for figuring out how much tax the company has to pay. So it's really important. But this is why having the right systems in place really means you're minimizing tax if you capture all your costs, but also really gives you a grip as to understanding what's going on in the business and quickly. You can see here that I've got my current year, 2022, and I've also added in a comparative. And just to show you Xero really quickly, it's so easy to do this. I can just click update and then my third year is populating. Now, albeit there's no data there, but I can then quickly buzz my eye along and see what's going on, and immediately click into any of these figures and find out what is going on in them. So I've just jumped into a balance sheet report. So balance sheet is things that you were able to use to make the trade. So things like you needed a laptop. Now the laptop is generated trade because you were able to put things online, to design an app, whatever it might be. It's things like cash. Cash has allowed you to then buy more product or pay for web development fees or pay for the female founder squad, whatever it might be. But these don't relate to the trade directly. They are not expenses. So here's an example. I've got my 3 columns again, so I can see my current year, my past year, and the year before that. So we can see we've got these things called fixed assets. So these are generally things that will generate income. So in a typical business, if you were in a farm industry and you had a tractor, the tractor is a fixed asset. It's a bit of plant and machinery, because without the tractor, you can't sow the seeds, so you can't pull the, I forgot what they're called. You get the idea. So without that tractor, the farm couldn't function. So without a laptop, the business can't function. Things like that. Coming down, we've got things called current assets. So these are money, or generally it's debtors, so people that are due you money, and cash, because these are realisable. We could get them paid in and that's it done. That we're expecting them within 1 year, basically. So cash we've got here. We've also got our accounts receivable, debtors, people that are owe you money. It's all the same thing. Then we have creditors. We're saying that these are liabilities, things that we have to pay within the next year. So accounts payable here is creditors. So these are things like invoices that we need to pay. There's some expense claims, things like that. And then there's VAT. So generally, most people will always be in a VAT liability, which means that they're due HMRC money. What then happens is we say, right, how much assets have we got? So that's our fixed assets, our physical assets, plus cash that we've got, plus anything we're expecting to receive within the next 12 months. And then let's take away anything that we need to pay out within the next 12 months. And that then gives us our net current assets. Generally, this is how businesses are valued, because this is where the value is. Now, what we have below this is the bit that shareholders are interested in. Generally, it's not showing here, but what you have down here is the total shares that are issued, how much money has been paid for those shares. So if I've raised 10 grand of investment, say, I would have my share capital here, £10,000, and then I'd have my current year earnings and my retained earnings. Now, this is the thing we spoke about with the dividends. I would have whatever the difference would be here. So retained earnings is really key, because that's what determines whether dividends can be paid. But then also this is really key to see, well, you might be making money or making profit, but does it make sense? Are you actually going into debt to try and make this money? Is it not actually covering the liabilities you've got to pay? Or have you got wads of cash sitting here, and actually if you invested some of that cash into a higher quality laptop or into a new website or into web development or app development, could you generate more income and more turnover and more profit, which then means more tax, but it all makes us happy, and it's the cycle of business. A very high level overview of a profit and loss and balance sheet, but hopefully that helps differentiate between the two. So that's a whistle-stop tour of some high level accounting, company sort of stuff. As I said at the start, not all of this is relevant if you're international. A lot of it is specific to the UK. But my main thing is capture all the costs as quickly, easily, and as efficiently as you can, and you'll save tax. I'm a big advocate for apps, connected systems, the whole thing. So if you can automate things, do it. Don't be scared to reach out to an advisor. And it's really key to get the right advice the start to make sure that you do things right going forward. I'd love for you to connect with me here on Female Founder Squad, drop me a DM, or you can find me on LinkedIn and check out our website to see a little bit about what we do to help our clients on an ongoing basis. So thanks very much for listening. If you're on the Startup Academy, I'll see you there, and have a great day.